Ready for the commissioners to come in?
Yep. I'll just turn off my phone.
Phones off, everyone, not just a silent.
Cool.
Silence, please all rise.
Good morning, please sit down.
Application 1 of 2018 on the Commission's own motion, 2018 State Wage Order pursuant to Section 50, capital A of the Industrial Relations Act.
Now we'll have appearances, please. Mr. Entrican.
May it please the Commission, my name is Brendan Entrican. I appear on behalf of the Minister for Commerce and Industrial Relations.
Thank you. Mr. Black.
If the Commission pleases, Keith Black. I appear on behalf of the Chamber of Commerce and Industry of Western Australia.
Thank you. Dr. Diamond.
May it please the Commission, Tim Diamond appearing for Unions WA.
Thank you. And Mr. Toomey.
Yeah, Chris Toomey, appearing for the WA Council of Social Service.
Thank you. Now, I note for the record that we have received, in addition to the submissions filed by those present, we have received a number of other submissions which have been posted on the Commission's website and which I note that a number of you in your submissions have commented on, so we will take account of those submissions also. Other than that, over to you, Mr. Entrican.
Thank you, Chief Commissioner. If it pleases the Commission and Court session, we'll begin with a presentation by our witness from the Department of Treasury on the economic outlook for Western Australia.
Thank you.
This will be followed by an opportunity for questions. I will then briefly summarise the Minister's position outlined in the submission and submission reply, which the Minister filed on the 15th and 18th of May respectively. If it pleases the Commission, we will now call Mr Christmas to the witness
Thank you.
box.
Please state your full name and address for the record.
David Brian Christmas, and I've got my address as my business address, 28 Barrack Street, Perth.
Do you sincerely declare and affirm that the evidence you shall give to this Commission shall be the truth, the whole truth, and nothing but the truth?
I do.
Good morning, Mr. Christmas. Please sit down.
Mr Christmas, can you please state your full name and position at the Department of Treasury?
David Brian Christmas, and I'm the Director of Economic and Revenue Forecasting.
And Mr Christmas, can I confirm that you've made a witness statement as part of these proceedings?
I have.
Okay. And is the original one the one you have with you in the...
I do have it here,
witness
yes.
box? And Mr Christmas, your witness statement states that you and your colleagues at the Department of Treasury have prepared the Economic Outlook document submitted as Attachment A, the Minister's primary submission. Is that correct?
It is.
Great. If it's convenient at this point, Chief Commissioner, I seek to tender the PowerPoint presentation that Mr Christmas will be speaking to today.
Well, perhaps we can have as Exhibit Minister 1 the witness statement of David Christmas, the attachment A to your submission, the 2018 State Wage Case Economic Outlook, and as Exhibit 2, the PowerPoint presentation. All right, thank you.
Very good. I have copies of the PowerPoint presentation here.
We have copies.
Oh,
of
you have copies?
Thank you.
Certainly.
Yes.
I'm happy to give these to the Section 50 parties. Attendees. Thank you. Thank you, Mr. Christmas. Could you please take us through your presentation?
Okay, thank you. Commissioners, today I'd like to present the outlook for the West Australian economy as summarised, basically largely in the recent 2018-19 budget. That was released on the 10th of May this year. And I'll cover elements of what was mentioned in the Commonwealth's budget as well, which was released on the 8th of May this year. So after growing at a very rapid pace for a decade, in more recent years the West Australian economy has slowed. In fact, in 2016-17, GSP contracted by 2.7%. That's the first time that's occurred based on the current estimates of GSP, which commenced in 1989-90. The moderation in growth, which has been evident over several years, is primarily due to softness in the domestic economy, and primarily due to declines in business investment. However, there's also been weak household consumption, and dwelling investment has fallen as well. That did flow through to the labour market, where employment levels actually fell in 2015-16 and 16-17. The unemployment rate increased in that period, and the wages growth has been and remains weak. While the domestic economy is expected to contract marginally in 2017-18 and 2018-19, there are some encouraging signs. For example, annual average employment has been growing since September 2017, underpinned by increases in full-time employment. Business and consumer confidence have been higher in the March quarter than for some time. The state's economy is expected to rebound, growing by modestly by 2.5% in the current year, and expand thereafter. But before going into the detail of the WA economy, I'll just go briefly to the global and national context. So, in its April 2018 World Economic Outlook, the International Monetary Fund is projecting that global economy will expand by 3.8% in 2017, up from 3.2% in 2016, with growth forecast at 3.9% in 2018 and 2019. After that, it is expected to trend down slightly to about 3.7% in 2023. WA's major trading partners collectively grew by 5%, so our trading partners grow faster than the rest of the world collectively. And growth is projected to decrease to 4.8% in 2018 and to moderate to 4.1% in 2023, calendar 2023. The steady easing in growth is largely due to anticipated slowing of growth in China, which the IMF is forecasting slow from 6.9% in 2017 to 5.5% in 2023. That forecast change is largely attributable to a slower property construction cycle and macroeconomic policies becoming less accommodative now that the 5-year leadership reshuffle is complete and presidential term limits have been removed.
There have been some concerns about the situation in China over the last 5 years or so, when before that it was going very strongly, and there were concerns for risk in Western Australia. That's not come to pass.
So far,
Moderated than.
so far the official stats will say that China has been growing at a solid pace. If you look at some other indicators, you can see a bit of a cycle going on. But yes, overall it's been very good for West Australia, and our exports, particularly iron ore, have been ramping up solidly. So on a volume or demand for our export basis, China's been a good story for us, and the official stats will show it's grown very well. There's always residual risk, and we
Yes.
continue to believe there's risks. A lot of that growth in China has been driven by debt-funded investment, and at some point you can't keep doing that. So for us, commodity prices are obviously very important, iron ore prices being a key part of that. Our commodity price index, in terms of if you average them out, the fact that it has sort of stabilised after declining in that period, around 2014-15, and in fact it's actually increased modestly since troughing about 18 months ago. The iron ore price, which is the key component there, in 2017-18 is expected to average about 68.3. That follows a price of 68.8 in 2016-17, an average price, that is. There is still a lot of volatility, so from month to month and over the year you do find some volatility. So, for example, over the year to date, commodity, the key iron ore index, which is what we base our price assumptions on, has varied between $57.40 and $79.95. So there's a bit of variance, but it's actually, in terms of our forecasts, stabilised. There's been a bit of a decline we forecast over the out years, and that's we're expecting iron ore prices to fall to around $60 to $63 range, and within that period there'll be some variance. That's just the nature of the cycle. The gold price, I think over the last 18 months has been increasing, and that's also supported the commodity price index. So we're expecting, in US dollar terms, a steady increase from a price of $1,258 US dollars per troy ounce in 2016-17 to about $1,479 a troy ounce in 21-22.
Is lithium going to be the next big thing?
Certainly, lithium looks like it. There's a large number of projects under consideration right now, worth in the several $1 billion worth of value. And just the other day there was an expansion of what is already the world's largest lithium mine, the Greenbushes mine, I think they're touting something like 600 million more. Now that's yet to receive final investment decision, but that's what the reported value is. Yep.
Thank you.
The Aussie dollar has actually, I suppose it's been increasing very slightly, but it's sort of varying around the 75-cent mark for the last couple of years. Probably a little. It's softened since the start of the year, and a lot of that's to do with expectations about interest rate rises in the US relative to interest rate rises here. That said, around 75 anyway. Just going into the national economy, the Australian economy, as forecast by the Commonwealth Treasury, is expected to grow by 2.75% in 2017-18 after expanding by 2.1% in 2016-17. As such, growth is expected to remain below the 3% per annum, but the projection period has it growing at 3% per annum by the end of the budget forecast. The increase in the rate of growth, growth is expected to be supported by increased exports, higher consumption, growth in non-mining investment, and a reduced drag from the unwinding of mining investment. Nationally, employment growth has been solid, increasing by 2.9% in annual average terms to April 2018. Employment is forecast to grow by 2.75% in 2017-18, and then to ease to 1.5% in 2018-19. That said, the Commonwealth does expect the pace of growth, employment growth, to be sufficient to result in an easing of the unemployment rate to 5% by the end of the budget period. One of the supports, I suppose, that the Australian economy's had is the fact that the RBA has kept its target cash rate at 1.5% since August 2016. So for a sustained period, which obviously would be seen as an expansionary rate, given it's so low. Turning to the West Australian economy, as I noted in my opening remarks, over the decade to 2014-15, and growth averaged around 5% per annum, over 5% per annum. But since then, and even in 2014-15, it started to sort of, that slow trajectory you can see on the chart there. So in the last few years, it's been a period of below trend growth as activity consolidates at a high level. West Australia's GSP, which captures both the domestic and international or external sectors, as I mentioned before, contracted in 2016-17, and that followed very weak growth of 1% in 15-16. That fall was largely attributable to a substantial contraction in the domestic economy, with state farm demand decreasing by 7.2% in 2016-17. And that was a result of even larger falls in business and dwelling investment. The contraction in domestic demand appears to have moderated over 2017-18 and is now projected to decline by just 0.25%. And both...
That dwelling investment's not a very significant component, is it?
No, it's not large. It's not large. Well,
and it's quite... And it's after 16-17, it almost disappears.
Dwelling investments, it's about, I think, $9 billion of the economy.
Okay.
So it's not, it's big, but it's small just because you're comparing it to the whole size of the economy.
If I may ask a question, in relation to gross state product, what kind of contribution is the agricultural sector making in terms of comparison between past and current performance?
So I've just got a value add here of what we've done here is exclude an industry that's called ownership of dwellings, which is a sort of a very nebulous sort of concept as an industry. But if you exclude that, it's the share of value adds around 3.3% in 16-17. It hasn't been...
I was talking about the agricultural sector. Are we talking about the same thing?
Yep, the agriculture, forestry and fishing is a share of the West Australian economy. as measured by value add, and remembering I'm excluding the ownership of dwellings, which is seen as an industry in the ABS stats, plus some taxes I've taken away. So just share of value of all the industries that are standardised industries, it's 3.3% in 2016-17.
So how is the agricultural sector going at the moment?
I think this last year was a bit more challenging, so they had a very good year, and then they've had a softer year, and now I think the outlook may be for a bit of a pickup. But it's not a sector that, it's not a large sector as a proportion of the economy. It accounts for about 3.1% of employment, so it's not a very big sector.
Thank you.
So basically following the contraction that we've just seen, we expect GSP to bounce back and grow by 2.5% next year, and to increase to 3.25 and 3.75 the year in the following years. SFG, which is why the domestic economy is expected to be very soft in this year and 2017-18 and 2018-19, but then to strengthen. And that's what you can see in this chart. This chart actually gives you a breakdown of it all. So over 2017-18 and 2018-19, investment will remain a substantial drag before contributing again in 1920. So it's really been the export sector that's kept us growing. And this year and next year, which I'll get to, is the ramp up in LNG. In terms of business investment, for the past decade, Australia's the profile of GSP growth has been largely influenced by trends in investment. Following a lengthy period of strong growth, investment has fallen substantially from 80.5 billion in 2012-13 to 38.1 billion in 2016-17, as major projects have been progressively completed. After declining for the past 4 years, we're expecting 2 more years of decline, and by the end of we're expecting 2018-19, investment will trough at $30 billion, around $30 billion. We're expecting investment to fall by 28.5% in 2016-17. Well, that's an actual, with a decline of 7% in 17-18 and an additional contraction of 14% in 18-19. After that, we expect investment to resume growing from 2019-20 onwards, in line with pre-boom average of around 6%. The continued falls in business investment in the immediate term are largely attributable to the completion of the hookup and commissioning of LNG projects, particularly Prelude and Ichthys. In the long term, investment will be supported by backfill investment, both in iron ore and in LNG. So there's several very large mines in the iron ore sector that will have depleting, quite a depletion, and they do need replacement in the next few years. The biggest of those is Yandal-Kajuna, BHP's Yandi mine, which is an 80 million tonne mine. However, both FMG and Rio as well will have other mines that are closing, will have to have replacement projects. And those are sort of scheduled, those we're expecting to occur or start within this period, and will be key to supporting our investment over this period. You may have seen a recent announcement that Gorgon Stage 2, which is some additional wells, is also coming on. Well, I think they're still... That's scheduled to come on in the period, and we're aware that there might be some other LNG stuff that may or may not come. So that sort of gives that... That's why we think there's going to be a trough and then a bit of a lift in the out years. Household consumption's been very soft. It grew by 1.3% in 2017, lifting from 1.1% in financial year 2016-17. Consistent with recent trends, growth has been supported predominantly by spending on non-discretionary goods and services such as health, housing and food. Discretionary spending made its largest contribution to growth, annual growth in more than 2 years in 2017, and you can see that little slither of light blue, which is 0.1 percentage points, and that was underpinned by a lift in spending on hotels, cafes and restaurants. The slight improvement in discretionary spending coincides with a lift in consumer sentiment, which reached its highest levels in the 3-month average terms in more than 4 years in February, although there appears to be some softening from that in March to May. But that's the Westpac Melbourne Institute measure. The WA Chamber of Commerce and Industry March 2018 Consumer Confidence Survey reported short and medium-term expectations for the state's economy were both at their highest levels in 4 years. So both those measures are saying there's been a pickup in confidence. And this chart shows annual average growth versus year-ended growth in household consumption. Treasury generally supports or uses annual average growth because it's a smoother series, and it just shows you actually what's happening over 4 quarters. But you do get a bit of an indication of what's happening using what we call year-ended growth. So year-ended growth, or annual average growth, will be the average of household consumption in, say, 2017 compared to 2016. Whereas year-ended growth, the latest figure is December quarter, just 1 quarter on the previous December quarter. And that, as you can see in this chart, tends to lead a little bit. And so the turning points, we often use as forecasters those as turning points, an indicator. So you can see that in year-ended growth being above annual average suggests that will pick up a little bit, although you can see that it's not exactly overwhelming.
Still less than 2%.
It actually reached 2.1%. It's probably just because it's so far from the other axis.
It looks like we're about 4 years away from returning to trend growth in consumption, roughly, on the something like that.
Yeah,
4%, if that's the trend line.
If you look at the next chart, you can see that actually we're not expecting it to reach the long-term average.
Maybe even longer.
Yeah, within the budget period. Consumption, we are expecting it to pick up to 1.75% in 2017-18. And so that's why that year-ended number gives us a bit of confidence that that'll be achieved, and then pick up to 2.25%. Housing consumption is expected to strengthen to 3.25% and then 3.5% by the end of the by 21-22.
And do you know or think, Mr. Christmas, whether household consumption is affected by the paying down of debt as opposed to households not having money?
We don't. I don't have solid stats on that.
I left think in there if you
Yes.
want to respond to that.
Yeah. What we did, the very limited measure we've got of, there's not a perfect savings rate measure at the state level. There's the best we can do would show that the rate of savings has declined slightly. So following the GFC, it went from, that indicator went from about 10% to around low 20s. And now it's come down from about 24.5 in 2014-15 to about 21.2%. So that would suggest there's a little bit of dissaving. Whether that's how that spending's been used is not something we have enough detail on. And unfortunately, because that includes what they call consumption of fixed capital, we can't be entirely confident. We can only use that as an indication of what might be happening. That said, as the economy strengthens and population growth increases, wages growth increase, and people are more certain about their employment prospects, together with a recent improvement in sentiment, we do expect a lift in household consumption. Dwelling investment here. We're basically, total dwelling investment declined by 18% in 2017, and that reflects declines in the two components of dwelling investment, new and used investment, which is what you see when a new house is being built, and alts and adds, which is what we don't necessarily see, but that's when you do an alteration, or you actually add a back room, or you do, it might be, in some cases you will see it because it's something out the front, but you can see there's a drop in the level of investment from the budget estimates last year to now, and that's all due to the way an ABS has revised the way it measures alterations and additions, and it actually resulted in alteration and additions value dropping from 3.7 billion to 3 billion in 2016-17. So those methodology changes can actually have a bit of an impact on the estimated levels of activity. That said, after slowing, so we're expecting dwelling investment to fall this financial year, 17-18, and then recover in 18-19, growing by 4.75% and 5.75 in 2019-20. There's some indicators that are sort of suggesting that the excess supply that are built up in the housing market is diminishing, so properties listed for rent and sale have been trending down over the past year, and rental vacancy rate has dropped from 6.9% in the September quarter of 2017 to 5.1% in the March quarter this year. So that's quite a rapid decline. The value of residential construction finance grew by an annual average of 3.9% in March, after falling by 11.8% in 2016-17. So there's been a turnaround in that finance. There's also been a turnaround in building approvals but it's still contracting, but less. The contraction's less. So you the shape is coming in the right direction, but obviously being negative just means we're watching that number very carefully.
And that's a leading indicator that looks at.
Yeah, something like building approvals would be a leading indicator, because the actual investment is the construction as it happens. The reduction in the level of dwelling investment since the budget reflects some. I've already mentioned that. So beyond that, we're actually expecting growth rates to ease slightly. So from 5.75 down to about 2.25 in 21-22, and that's just because the lift that we're expecting in the next 2 years is occurring in a relatively balanced market. So you're not going to get out of kilter. So we're expecting a bit of a strengthening and then it's still to grow, but moderating. So a sort of very soft dwelling cycle by historical standards. Putting those three private elements of state final demand together, you get a picture of what's happening in state final demand of the domestic economy. And so you're seeing that in 2017-18 and 2018-19 we're expecting just a shade under flat levels of activity, so minus 0.25 percentage points in each year, with investment being the main drag. And if that occurs, that'll be the, if our forecasts materialise, 2018-19 will be the sixth consecutive decline in the state's domestic activity. And while that's a long period of extended weakness, it does follow a period of very strong growth as well. Going to exports, the high level of investment is flowing and has been flowing through to a strong expansion in the exports. So we're estimating they grew by 5.5% in 17-18, underpinned by growth in LNG and iron ore. And we're expecting that to grow to 7.5% next year as Wheatstone, which is another LNG project, has a sort of really consolidates its ramp up, and then Prelude starts to export. Prelude's a floating LNG plant that is actually still close to finalisation, but should start producing next year. In addition to the LNG ramp up, there'll be gold, iron ore and lithium expansions as well. The LNG is a big story though. I mean, over the last 3 years, or the 3 years to 2019-20, LNG exports are expected to increase by about 70%. By that, so we'll account for around 10 to 15% of global production.
Pretty massive story, isn't it?
It
Really?
is.
Without that, it would be a different picture.
Yes, yeah. A very different picture, both in the past because the projects themselves are such high value, so the investment would have been lower in the past. Yeah. In the later years, we actually have investment slowing off a lot because all our LNG and iron ore projects are basically operating at capacity. So, population growth is very weak at the moment. So after peaking at 3.1% in 2012-13, or the most recent peak, the population growth slowed to 0.7% in 2015-16 and has remained at that rate in 2016-17. These are the weakest rates of growth since at least early 1980s, and I understand maybe since the Second World War. Population estimates are released with a significant lag, so the latest population data is September quarter 2017, in which, in 2016-17, population grew by 0.7, and that ticked up to 0.8 in the year to September quarter 2017. The main reason that's it's so weak now is net overseas migration to the States has fallen in the year to September quarter 2017 to 13,800 persons, down from around 53,200 people in 2011-12. So much that decline's been very rapid, and what it's resulted in is our share of national overseas migration, net overseas migration, falling to 5.5%, well below our long-run average of 13.5%.
Mr. Christmas, what's going on in New South Wales that they can absorb? I imagine they're getting more migrants than they previously were. They seem to be able to absorb it, and industry is performing at a level which allows them to have the lowest unemployment rate in the country. What is going so right for them over there that's not happening here?
Well, I mean, I think for us, the story is because we're coming off a high base, and so growth was actually inevitably going to slow. Over there, I haven't tracked their economy particularly closely, but from what I hear, there's a lot of construction and infrastructure investment happening. So the sale of some of their electricity assets has resulted in a lot of infrastructure investment. And I also think the Commonwealth bought Snowy Hydro and said, off New South Wales and Victoria, and said, well, you've got to use that money. We'll buy it on the condition you use it for infrastructure as well. So I think there's a fair bit of construction, and a lot of infrastructure over east. So that's a potential pressure point because there's so much happening at the moment across the country.
Thank you.
And there's also a lot of people flying from WA to the other states. That's 11,581 people in the year to September 2017. Both those, over time we do expect a reversal. So we expect our share of national NOM to increase to 13.5%. That was an extremely stable level prior to the boom. So that, together with a return to net interstate migration to the state by towards the end of the period, means we have that growth profile that you can see there. The reason why we think net interstate migration will start flowing back is because our domestic economy is forecast to start growing at the same pace as the national, so you'd expect a normalisation around the same pace. So going on to the labour market, monthly data is very volatile, and so one way of looking through that volatility is to look at growth in annual average terms. So annual average growth in employment increased by 2.3% in April 2018, and as you can see from this chart, that shows contributions to that growth from full-time and part-time, and the majority of that was part-time, albeit you can see just towards the end of that, the series we've got up on the screen, full-time, the contribution from full-time started to soften, and part-time's starting to pick up. Now, some of that, a proportion of that increase was likely to have been from the hookup and commissioning of the Prelude and Ichthys projects, and those projects are expected to be commissioned pretty much any time soon. I think INPEX announced that their expectation was somewhere around April, May. I think they've also suggested there might be a little bit delay to that, but both projects are imminently, are very close, a matter of months towards being completed. So we expect employment to grow by 2.25% in 17-18, after falling by 0.9% last year. That forecast for employment growth reflects strong growth in annual average terms, improvements in lead indicators of labour demand, and advice we get from industry consultations about hiring. So as this next chart will show you, the next chart does show you, internet vacancies have increased in the last 18 months. Department of Jobs and Small Business data show that the number of internet vacancies was 17.6% higher in March 2018 than the same time a year earlier. And that's occurring at the same time as that business confidence has been picking up as well. So both the NAB and CCI WA surveys or measures are showing that business confidence is now around its highest level in 7 years. So all that sort of bodes well for a good employment outlook. One of the interesting things about the internet vacancy data is that now vacancies have increased in more than 60% of occupations in the year to March. This next chart really shows that despite the improved annual average growth, we do expect it to slow in 2018-19, and that's consistent with that lead indicator, the quarterly year-ended growth, leading annual average growth. But one of the main reasons we think it will slow from to 1.5% in 2018-19 is because those LNG projects are coming to completion. And while there'll be I'll leave it at that. Beyond,
Sorry to jump in, Mr. Chris. So go back to the employment growth shown on page 10, where there was that big spike in early 2010. If you've got it in paperwork in front of you.
Yep, now I'll just go to that. Yep.
See that big spike in early 2010? In employment growth, it went from zero.
Oh, is this in my the attachment A? Is it? Or?
It's the PowerPoint, but it's page 10 of the PowerPoint once it's printed out. The first graph under the labour market.
Oh, okay.
Yep, that one.
Yep.
So, do you know then that that's not going to be repeated because you know there were projects driving that in 2010 that simply aren't that aren't planned at the moment. So you know that's not going to be repeated.
We're very confident we're not going to get those levels again.
Yeah, because the 2010 was based on projects that were either under construction or...
Yes, and the size of those projects.
The size of the projects.
It's actually the size. Yeah.
Okay, thank you.
So we had in 2012-13, I think that was our record year of investment, which is over 80 billion. We're not expecting investment to come anywhere close to that.
Okay.
Sorry. This chart really just shows that after the 1.5%, we are expecting employment again to resume increasing at a slightly faster pace, and that's just as the economic conditions improve and business investment starts to lift again. This chart here just shows the employment by industry in the year to February 2018, which is the latest data available. It's only published quarterly. Growth is being driven by a handful of industries clustered in the services sector. Education and training and healthcare and social assistance being key, as well as construction and agriculture, food, forestry and fishing.
And yet the retail trade, for example, is very subdued.
Yes, that's correct. Mining, outside of oil and gas, would probably expect a lift in mining in the coming years, simply because we're hearing that on the ground. The unemployment rate, so monthly figures for the unemployment rate are volatile, and our recent experience is a good example of this, with the unemployment rate increasing from 6.1% in February to 6.9% in March and down to 6.5%. So again, that's one reason why we use annual average. West Australia's unemployment rate was 6% in April 2018 in annual average terms. That's down from an unemployment rate of 6.2% in 2016-17.
Participation rates have an impact, don't they, on a short-run basis?
They do.
And that's the difficulty with volatility.
Yeah, they're as you say, they're also very volatile as well. But a lot of that lift in the unemployment rate recently is because of the increased participation, which is sort of consistent with an encouraged worker.
Well, that's a good story, isn't it?
Yes, yes, that's correct. Yep. And in annual average terms, aside from New South Wales, our annual average rate is sort of in the range of other states, with Victoria at 5.8 and Queensland at 6.1. So, despite the marginal increase in the unemployment rate in the last month or so, other measures of spare capacity in labour market have been declining. So, for example, underemployment rate has actually fallen to 8.8% in February. And I'll get to the underemployment rate in a minute. Revisit that in the context of wage growth. Okay. In terms of the unemployment rate, we expect so the recent increases in the unemployment rate monthly have pushed up the annual average rate to 6.0% in April 2018. And reflecting that, there is an upside risk to the unemployment rate forecast. We've got it at 5.75, but there's a distinct possibility that the unemployment rate could be 0.25% per 0.025 percentage points higher than we forecast, so possibly 6% in 17-18. In 2018-19, the unemployment rate is forecast at 5.75%, with progressive reductions in the rate to 5% by 2021-22. And again, that's just reflecting our expectation of employment growth, pushing down the rate eventually. In terms of where the different cohorts do actually have different unemployment rates, so the unemployment rate in the year to March 2018 was 14% for 15 to 24-year-olds.
We did very well for a few years. What is it in these last 2 years that's been the difference?
At one level, we can only, I suppose, speculate on that. So it may reflect the nature of available jobs, or firms having a preference for skilled labour, given that there's some slack in the market, the choice of skilled versus non-skilled. But again, I don't have hard data on that.
Yep. Okay, thank you.
The part rate has been trending upwards recently and is expected to rise to 68.1% in 2017-18, up from 67.3% in 16-17. West Australia's our participation rate over the year to date has been a bit higher than at 68.2, so there's probably some upside risk that the part rate's higher and therefore the unemployment rates are consequently a bit higher. And beyond that, we do expect some further increases to 68.8% in 2021, and levelling off roughly at that at 68.7 in 21-22. So just turning to wages, we do, while there's a number of indicators of wage levels, we can use them for wage growth. Our preferred measure is the wage price index, and that's, I think, a generally viewed measure, best measure of underlying wage growth. That's because it measures wage changes for a fixed quantity and quality of labour, thus abstracting from compositional changes in the labour market, such as hours worked or movements between industries. And so this presentation will focus on WPI. And the chart does show that wages as measured by WPI are weak, but they appear to have stabilised. In fact, over the last 4 quarters, quarterly growth in WPI has averaged 0.4% per quarter, compared to the previous 4 quarters to March 2017, which was 0.3. So not a big difference, but it's showing in that marginal uptick in that annual average growth on the blue line there. So forecast growth in 2017-18 of 1.5% is only slightly higher than 1.4% in 16-17, which was the lowest rate of growth over a financial year on record. And real wages grew by 0.6% in the year to March 2018, compared to 0.5% the year earlier. So the subdued rates of wages growth is consistent with weak domestic economic conditions and the presence of ongoing spare capacity in the labour market.
The Reserve Bank continually says, does it not, that low wages growth is a problem for the economy? Is that...
The bank has been saying that people are interpreting, and the governor's, I think, fairly careful how he says it. And I don't have his exact words in front of me, but basically he's saying that a little bit more wage growth would be a good thing.
do you have good knowledge of the economic situation of the West Australian government, Mr. Christmas?
Sorry, Commissioner.
Do you have good knowledge of the economic conditions affecting the West Australian government budget? Is that something that you're knowledgeable about?
Well, this is all. These are all. What I'm going through today is basically the parameters that our budget estimates are based on.
Okay, so who's best placed to do something about wage growth, the West Australian government or small business, in your view?
Well, as you'd be aware, the public sector is trying to moderate expense growth, because
from an economic point of view, given your knowledge of government and your knowledge of business conditions, putting to one side government wages policy, who's best placed to do something about wages growth, the government or small business?
Well, I don't think it's just as easy a response like that. In one sense, the government has wages policy as a lever a policy it can use. Ultimately,
Well, government makes a submission here that there should be a 2.7% wage increase.
Yep.
Now, government's not offering a 2.7% wage increase to anyone above about $36,000, I think, is where the 1,000 starts to look like a 2.7%. So my question is, and if you can't answer it, fine, but who's best placed to make a difference to wage growth, government or small business?
Well, business will offer wage growth where there's competitive pressures. They don't.
We'll be telling them to increase wages by our decision.
Mm-hmm. Yep. So that's one instrument, and the government's got its public sector wages policy. There's just two different instruments.
But small business might say to us, we can't afford a 2.7% wage increase.
So what I'm doing is outlining...
The government is saying we can't afford a 2.7% wage increase.
Yep.
Who do you think would be best placed to absorb it?
Well, the government's obviously determined that its wages policy is what it can afford, given its financial outlook. And what I'm presenting to you is the conditions that the small business is operating under. Every business will be in a slightly different position. But what we're doing is going through a period where business conditions are getting better. That said, you need to keep in mind that at the same time, you don't want. It's all a matter of degree. You don't want excessive increases in minimum wage, because excessive increases can't actually be passed on, given the current competitive environment. But more modest increases.
The Fair Work Commission last year redefined modest. So they said that the labour market, evidence suggests, is not affected by modest increases. They said, let's just say that's accepted wisdom. So then they focused on the word modest.
Mm-hmm.
Has there been an effect on the national employment market as a result of the Fair Work Commission's decision last year, to your knowledge?
Well, I haven't looked at what's happened with employment of people who had been affected by that decision.
But let's just say
As a
New
general
South Wales is the biggest economy in Australia. And since the Fair Work Commission's decision, the unemployment rate in New South Wales has dropped, has it not?
I haven't actually monitored the, well, I don't have a recollection of exactly where it is, but we do know that New South Wales unemployment rate is, I think I mentioned earlier, about 4.8%, something of that order. And indeed, as a general observation, again, this is just a general observation, employment growth nationally was strong last year.
Thank you for doing what you can with my questions, Mr. Christmas. The situation I didn't want to find myself in is putting these questions to Mr. Entrick and him saying we should have asked the expert. So thank you for doing what you can.
Right, yeah. No worries. Sorry, we do. In some cases, we can only make those general observations. Yeah.
I suppose matters of government policy are not for you.
Well, yes.
Yes.
That's
I got that idea.
I might just ask you one question though, because what you said about the issue being around excessive versus modest seems uncontroversial, and certainly as a submission I think has been made in the last two at least decisions that I've been a part of, and I'm sure many before that. The research coming out of the RBA recently also seemed to confirm that that modest increases don't have a negative effect. And the issue for us is that people don't agree about what modest means, obviously. Now, the Minister's submission says 2.7. You're here as an expert and you're telling us about the general conditions. Does that strike you as a modest increase?
Look, that in this is where the line is drawn at modest and excessive is, yeah, I mean, is a bit of a matter of judgment. Clearly, I think I don't recall the exact size of the wage increase last year, minimum wage increase, but we've got the government's put forward a rate which deems is within that definition, given the current context, I would suggest. But in terms of, I do, it's not something I haven't thought of, but no one's actually defined what these terms are. And I, to be honest, want to spend more time before I define exactly what I think is in the cut-off. But, yeah, how this, that's really, I would, when I've seen people talk about excessive, they go to the other extreme and sort of say, you know, 10% or more. Well, that's not, I'd suggest excessive might be a little bit below that, because that's a very big number. Yeah. So
I suppose modest and excessive would have to be relative to all of the current circumstances and history
yes.
of what wage increases were relative to those times as well.
That's correct. So definitely the economic context is important, and it's not that I had a look at that RBA research, and it's good in addition to the literature, but there's always that. what I think you will find is that the view is, notwithstanding that generalised rule, the current conditions, as the Chief Commissioner has noted, do need to be taken into account.
Thank you.
So, one thing I would note, in terms of going back here, we do actually expect wages growth to pick up, and the year it picks up is when business investment, household consumption and dwelling investment are all in synchronicity. They're all growing again, and so that's where you have that pickup in demand. On this one, this chart really is just to show you that this is one of the closer economic relationships graphically that you'll see. So what it is what growth in WPI versus the inverse of the underutilisation rate, which the underutilisation rate is a combination of the unemployment rate and the underemployment rate. So so I mentioned before the underemployment is really people who are wanting more. They're employed, but they want more hours. So it's a measure of slack in the labour market, and underutilisation rate has actually improved. So it's gone from 16.4% in February 2017 to 14.6% in February 2018. So that's sort of consistent with our view that WPI will be starting to pick up. And we don't forecast the underutilisation rate, but implicit in the fact that we think WPI is going to pick up, we're assuming that the slack is taken out of the, is being taken out.
Logically, it would follow, wouldn't it?
Yes,
Yeah.
yes.
So there seems to be an inverse relationship, but also a lag between the two. They track.
Yes.
They track quite well, but there is a lag.
Yes, because it's not an exact relationship. I'd agree that generally there's a lag. Sometimes it appears a bit contemporaneous, but either way, it's either lagging or contemporaneous. Yeah. Just in terms of the consumer price index, that's been really weak. It grew by Perth CPI grew by 0.1% in the March quarter, increasing by 0.8% in annual average terms to March. That's slightly higher than 0.6% growth in the same period a year earlier. The largest contributors to the annual increase are alcohol and tobacco, transport and health.
I'm sorry, what was the first one?
Alcohol and tobacco. Yep. And the largest detractor from annual growth was housing, consistent with continued falls in rents and project home prices. Notwithstanding the weak result in March quarter, we do expect that our estimate of 1% is reasonable for 17-18. You'd really need a quarterly change of between 0.1 and 1% in the June quarter to get that, and that's a fairly big range. And in the past 3 years, quarterly growth's been 0.2, so yeah, we're fairly confident we'll hit our 1%. When I say 1%, we actually have, that could be 0.9 or 1.1. We have a 0.25 sort of range. So beyond that, following a forecast of 1% in 2017-18, Perth CPI is forecast to increase by 1.5% next year, and to increase to 2% and then eventually the midpoint of the RBA's target range of 2.5%. Over the period, prices will be supported, price growth will be supported by increases in Commonwealth tobacco excise of 12.5% per annum, at least in adding 0.3 percentage points to inflation in 2018, 19, 19, 20 and 2021. And there's also increase in administered prices like health insurance premiums, education costs, property rates and charges and utilities. In the short term, as in 2017-18, there were pressures from those, which are ongoing every year pretty much, have been largely offset by weak housing market. However, as the housing market starts to normalise, that won't detract as much, which is why you've got that upward growing profile. And the reason why our sort of inflation forecasts differ from those of the RBA and the Commonwealth Treasury do reflect that housing component, essentially. That it's been a drag here, and up to date, it hasn't been a drag over east. So risk to outlook, really we see, there's many more risks than the ones that are summarised here, but investment and the magnitude and timing. So even Ichthys, I think, has suggested there may be a little bit of a delay and there might have been a cost blowout in its project. They don't always give details, and that was a media report. Whether that's accurate is also an issue. But it's inevitable with projects the size of our LNG projects that a quarter this way or that way can actually make a bit of a difference in terms of both investment numbers and employment numbers. If investment ends up translating to be weaker than anticipated, then growth will be. The outlook for population growth creates a general element of uncertainty for the domestic demand. If overseas migration remains at current levels rather than lifting as we think, growth in consumer spending and dwelling investment would be lower than forecast. And while growth in annual average employment strengthened in April, or the year to April rather, employment growth has been modest since the mid-2017. If that continues, employment may be weaker than we forecast, which may lead to higher than projected unemployment rate. And finally, housing market, there's also a risk that dwelling investment and housing prices may decline more strongly than forecast. For example, if population growth or labour market conditions are weaker than we expect, and the potential for tightening in residential lending criteria. So we don't know how either the regulators or banks themselves might respond to the Banking Royal Commission, but they may, either of those two may result in some tightening in conditions. They may not, it's just a risk. And globally, China, I did mention the rapid debt accumulation, so a lot of their investment's been debt funded. They also have some very unfavourable demographic trends going on, so it just means that they're more, I suppose, at risk of a financial disturbance than they may well have been previously. And then the US government's rhetoric around trade protection has translated into modest tariff announcements. Some tariff announcements. Now, whether those actually materialise into sort of a trade problem is yet to find. Well, I mean, I'm hearing in recent days that China and the US have sort of sorted their trade issues out. So it may well turn out to be that way. One never quite knows with the current administration in the US. And but the real issue, probably the bigger risk, is US monetary policy and rate rises there, and whether they increase rates too fast, and if they do, then we could be adversely affected. So those are also key risks from our point of view. Yep. That essentially is the outlook. Sorry, I have one more page. This is just to bring it all together. So activity in WA's overall economy appears to have troughed in 16-17. So GSP looks like it's troughed, and we're expecting it to come out of that trough in 17-18 and 18-19, supported by strong growth in exports. Activity in the domestic economy is yet to trough, although the rate of decline is expected to be small in both 2017-18 and 18-19, which is the year the domestic economy is expected to trough. So 2018-19 is when we think SFD will reach its lowest level. Growth in key sectors of domestic economy have been either weak in the case of household consumption or negative in the case of business investment and dwelling investment. That said, there are signs that the economy is close to turning. A modest pickup in household consumption in year-ended terms over 2017 and a strengthening in consumer confidence in early 2018. A strengthening in business confidence in 2018. And there's been a number of project announcements. So Gorgon Stage 2 and Greenbush Lithium projects are two. In the last fortnight, I think they've both been announced or in the media. And improvements in labour market conditions over the last year have resulted in a lift in employment and a decline, albeit modest, in the annual average unemployment rate, and participation rates are increasing. So those signs are positive. Notwithstanding that, domestic conditions remain soft, and that's reflected in historically weak wage, price and population growth. Growth across all key elements of domestic demand are not expected to lift for another year, so that's when business, investment and dwellings and consumption are all growing in sync, which we expect in 2019-20. So this time next year we'll be very close to that.
So we're still very, very much influenced by the prospect of new projects within our resources sector, still driving the economy.
Yes, those projects are really what is driving growth, our forecast of growth. That's not to say there won't be other sectors, and obviously the government's announced some initiatives to try and boost tourism, for example. So that's in the budget. So there'll be things outside of that. The other thing is the infrastructure program, Metronet. So it's the public stuff, but again, it's sort of infrastructure, but it's an investment.
Just on that, Christmas just reminded me that the Commonwealth budgeted, or I think has, seen figures of bandied around the media of 3.4 billion in infrastructure assistance, euphemistically described as the GST top-up. Is that factored in to the numbers in terms of projections for growth, or is that something which is sort of off balance sheet at the moment? Or is that a bit hard if you don't know? Don't know, but
my understanding is that I don't know if 100% of it is, but I know I believe a fair amount of it is.
Would be included, presumably.
Yeah, and so therefore we would include. I haven't actually talked about public demand in this presentation.
It's a different factor.
But yes, nevertheless. So I don't think the Commonwealth's adding to that what's been publicly announced is adding to the outlook that we've presented in an economic sense.
Thank you.
Thank you, Mr. Christmas. Mr. Black, any questions?
Thank you, Jeff, Commissioner. Just got two brief questions. Thanks very much for your presentation. The first one relates to the domestic economy, and you mentioned that we've still got a bit of retraction before we expand in 2018-19. Does that mean that, in your view, we still have some challenges ahead for us in the coming year?
So we're in 18-19. The main reason you've got domestic demand contracting is we've got a 14% decline in business investment forecast. And the main driver of that is activity on those LNG projects coming off. So that's the challenge will be. The challenge is really associated with those. Outside of those projects, you'd actually, in underlying terms, so if you could strip them out of history and then strip them out of next year, you'd probably actually have some positive.
Of the two primary moving parts we have in the economy, investment and net exports, which would you say is the bigger contributor to jobs growth?
And the investment is the labour-intensive phase of production. Now, so that's across iron ore or LNG, but LNG is very particularly labour-intensive in its construction phase relative to production phase. I recollect, numbers are like, maybe 18, something in this order, so don't, but it's that sort of order of, 18 to 1 type, 18 people. But again, that's a very isolated, those are big projects in themselves, but in terms of the total labour force, they're, you need to keep that perspective.
Sure. But with investment, and it has been declining as you've indicated, with an increase in investment, that would bring jobs with it.
The investment backfill we're expecting is going to support our employment outlook, that's for sure.
I just want to probably refer to to attachment A of the Minister's submission, which was the second last paragraph relating to employment risks.
You're at page 21.
Page 21, yes, Chair.
Yes, thank you.
And the second last paragraph.
The last page, second paragraph.
Yep.
So this paragraph of attachment A indicates that if modest growth in employment that we've had since mid-2017 continues, then employment may very well be weaker than the forecast in the near term and flow through to higher projected unemployment. This appears to suggest that we have a high reliance on employment growth, and if that isn't achieved, we have a risk to recovery. Would you agree with that?
I think the risk is not that. It's a risk to the magnitude of employment growth. That doesn't mean we're expecting employment not to grow in 2018-19. So I think we need to just balance that. Yeah. So.
But it could potentially risk that planned recovery growth over the next 18 months, year to 18 months.
Well, I suppose we're already building in some softening. We're building in a softening in the rate of annual average growth in employment. Now, if employment growth remains weaker in the next period, you're going to have a softer employment growth, and that growth does flow through to things like housing consumption and whether people come to the state. So yes, overall activity will be slower than currently forecast. That's just the nature of it.
Thank you very much, Mr. Christmas. That's all for the Commission.
Dr. Diamond?
Thank you, Chief Commissioner, and thank you, Mr. Christmas, for your presentation. So I'm going to ask you to do something a little bit complex with flipping this handout around a bit. But if I just ask you to go to the first one, which is the Australia's key export markets.
Mm-hmm.
And as we've already discussed, you're projecting a decline in those conditions moving into the future.
Well,
So I'm just trying to look at how that would interact. And once again, I apologise for the flipping around. How that would interact with the other graph that you have, which is to do with merchandise exports, which is just after the state final demand,
yes.
where you're obviously forecasting an increase.
Yeah, just about there.
Yep.
So,
So how do those two interact, essentially?
well, growth in China and Chinese demand has been critical for growth in our exports. With in the last decade, iron ore exports have something like tripled. Now, but we're not forecasting our future export growth isn't relying on that same sort of trajectory. As I mentioned earlier, by the end of the period, most iron ore producers are going to be producing close to capacity. And so that's reflected in that sort of flatter, it goes from increasing to a little bit more flat towards the end of the period in terms of levels.
Mm-hmm. And there's a similar effect in LNG as well?
LNG will also, it's as I said, growing by 70% in the year to 2019-20, and then flattening off as well.
Okay. So if we move back, once again, a few charts, I crave people's indulgence, to the one on growth state product, or gross state product. So that's second chart in from the West Australian economy. Contributions to growth. Now, my eyesight is perhaps a little bad with some of the colour shadings there. So I'm just having a look at sort of what can you read off about the contribution of net exports to future growth?
So net exports contribution is coming down substantially.
Okay, so in that sense, would it be fair to say that we're going to be relying for, if you like, the economic resilience of Western Australia into the future on those other components of gross state product, including elements like household consumption?
Yep. So while there's still contributions from net exports, which means they are actually still helping the economy grow, the rate of growth is obviously being largely supported by the non-export sector. Okay. But it's more balanced than it is now, where it's largely driven by one.
Mm-hmm. Okay, so with that in mind, and once again I'm going to crave people's indulgence as I move to... moving along, after the business investment graph, you have the consumption by category graph.
Consumption by category.
Consumption by category.
Yes.
So, gross state product, business investment, that's the one. So, given that the discretionary component of that particular consumption by category, which has obviously gone down overall, and the discretionary component, which was quite high, if you look around sort of December 11, seems to have sort of pretty much vanished off the charts on that score. To what extent would you say that wages growth and the capacity to spend on discretionary or quote-unquote non-essential items would contribute to actually lifting levels of discretionary spending?
That's not something I have any detailed analysis of. But we are nonetheless expecting a number of things to drive that. So one of the reasons why that's so low is just because the number of people coming in the state is growing at a lower rate than we've done, and as you have more people, your consumption is going to grow. So you're going to have that, but you also have things that we haven't seen for a while coming into play. So we expect wages to start lifting, albeit modestly, but also we're coming off a period where house prices have been negative, whereas we're not expecting very strong growth, don't get me wrong, but at least the wealth effect, we are expecting some very modest increases in the house prices, which, you know, will have a little bit of a wealth or positive, give you a bit of a positive feeling. But again, I don't want to overplay that. But when you've got, in 2018-19, we're expecting sort of the median house price to actually grow after at least a year or two of either falling or flat prices. So, you know, that may make people feel more comfortable. The fact that confidence is up also suggests that, you know, where you're more confident, you may spend more on discretion rather than just pure need.
And you are, I think in another chart, you're expecting, obviously, population growth to increase in Western Australia. That's
We
one of
are,
the
although
basic
it's
forecasts.
a pretty it starts off more gradually before picking up.
And the discretionary spending items, so you've got there cigarettes, alcoholic beverages, clothing and footwear, hotels, cafes, restaurants, etc., etc. All of those would involve spending in, if you like, very much the capital D domestic economy, as in places that are, as in spending within Western Australia, sort of households going out, households contributing to general demand and economic activity within those services sectors.
Yes, you would. One of those items, purchase of vehicles, you know, most of those will be imported. But, yeah.
Okay, and both yourselves, and WA Treasury, I should say, and the Federal Treasury, and also the Reserve Bank of Australia are all basically forecasting wage increases or the wage price indexes to go up.
The Commonwealth Treasury is also expecting the wage price index to go up. Yeah.
And so on that score, one of the things that the Reserve Bank has recently, one of the charts that the Reserve Bank has recently put out is pointing out that the wage increases that Australia has experienced over the last quarter or so, or over the last year, I should say, has essentially largely come from the national decision to actually increase the minimum wage by about 3.3%. Is that a perspective that you would agree with?
Well, to be honest, I haven't seen. I'm not disagreeing that that's not. I just haven't seen that, so I'm not in a position to really comment on what the RBA has done, and I haven't personally tracked done the analysis that you're alluding to. So I don't feel qualified to make a comment really.
But you feel that that's does that sound to you as a reasonable sort of conclusion to draw based on the sort of lack of wage growth coming out of other sectors of the economy?
Well, it'll be a contributor. I'm not in a position to say the relative contribution of that decision compared to, decisions or agreements reached between employees and employers outside of, or above minimum wage across the country. I really just haven't. What I do know is that our rates of wage growth are lower than nationally, and nationals I think have been also relatively soft, but so nationally, 2% increase, and so that decision would have been on the high, contributed to that growth. But again, there's a lot of other factors, and I haven't done the analysis to draw the relative contributions out.
Absolutely, and I fully understand that. But would it be fair to say that if wage growth is being forecast, wage growth is being projected, then it does sort of open the point that at some point wages have to increase, which means somebody has to make the decision to increase wages at some point. So, I mean, when the Treasury does these projections, what do they see as the sources of wage growth?
Well, obviously one of the things we look at is aggregate demand, so domestic conditions will be part of that. The degree of slack in the labour market, and I've talked about that. There'll be some extent to which wage growth, wages agreements between employers and employees nationally impacts on us as well, because you've got companies operating nationally and their wages may, nationally wage growth is higher than ours. So to the extent that agreements across jurisdictions, and there may be some spillover of wage growth nationally to us.
And you include aggregate demand, you said, in those
Definitely,
particular.
that's a key aspect of it.
All right. Thank you very much, Mr. Christmas. No further questions.
Thank you. Mr. Toomey, do you have any questions?
Yes, thank you. I noted in your chart, Mr. Christmas, where you're talking about the contributions to growth, that household consumption in the out years is increasingly making a large contribution. And when you were talking about the components of household consumption, you said as population and wages growth increases, we do expect an increase in domestic consumption. I guess the issue that I wanted to ask is, to what extent are your projections around GSP growth and economic recovery very much dependent on growth in wages and the wage price index? Because I did note when you were talking about the risk factors, you didn't mention wage price growth at all, but I've seen 4 articles in the last week, a couple from professors of economic on The Conversation. There was one recently in the West that were pointing specifically to wages growth as the potential weak link in projections around budget recovery. Is that a fair comment?
There certainly has been those comments made. I think they've been made for a little while. So this budget wouldn't be the first time those observations have been made by commentators. And I'm not talking about necessarily the WA budget. Commonwealth budget is probably the one that gets a bit more press in that sense.
Yeah.
But look, the nature of macroeconomics is there's linkages, but all different ways. So your aggregate demand generally means you lift your employment, and as your slack comes out of the economy, your wages will lift, which will support stronger consumption. And so there's lots of interrelationships. And if wages was less than we thought, well, yes, we would expect that household consumption will be weaker than we anticipate. We actually have a lower WPI forecasts are slightly below the Commonwealth across the period.
But they are still growing
growing.
dramatically, I think up to 3.25% over forward estimates.
I believe that's right.
Yeah, and the Commonwealth I think goes to 3.5.
5, I think, yes. Although I think
that's still quite significant growth. I guess my concern there is, what is the risk around those projections if that wage growth doesn't occur? How much of a contribution might it make to the wider projections around the WA economy?
It really does depend on how the future plays out. And so what I mean by that is we're expecting investment to happen. And it really depends if there whether that investment creates enough demand for wage growth more generally. Doesn't mean that the demand may be sufficient to get some slack down, but not sufficient to support too strong wage growth. So investment could well drive activity still, but the counterbalance is that household consumption would probably be a little bit weaker than otherwise.
Yeah.
But it really depends on how that balance between employment and wages plays out.
Because I guess one of the concerns, and this was in some of the comments from the Reserve Bank Governor, was around whether that, nexus, as you were saying, in increases in demand and also, for instance, increases in productivity, whether that was actually still being reflected in wages growth. Because this is one of the big concerns at the moment, that if demand and productivity isn't being reflected in wages growth, then it suggests that the only mechanism that's really there comes around toward wage setting and the minimum wage. Do you feel that's a feasible suggestion?
Well, all I'd be comfortable of, I haven't actually, again, looked at detail on what the Governor's said. I've heard the interpretations of his comments saying that we need more wages growth. Now, wages growth obviously does impact on consumption, and to the extent that you don't have as strong a wage growth as forecast, everything else being equal, so the employment rate, being what we thought it would be, and that sort of thing, you would expect households were more income constrained and therefore be a bit more careful with their spending.
Yeah.
That's about as far as I'd be prepared to sort of comment on a general level.
In terms of the Minister's submission and the $19.20 increase that they've suggested there, has Treasury been asked to do any projections at all about what the impact of that would be on wages growth? Would that scale of increase lead to the type of increases you're projecting in the future, or would you need to be pushing for larger increases in future years to actually meet that level of increase?
In terms of obviously a certain proportion of people are affected, and how that where the relative size of that component relative to the whole economy will impact on the size of that, and I think there's some evidence out that's been provided on, and there's a bit of uncertainty from what I understand is the actual exact coverage, right? So
Yeah, in our sector that's around 30%.
Yeah. Around 30%. Okay. Well, I haven't got a number on how that would impact. We haven't actually done that. But obviously 2.7% is above the current WPI, so you'd be contributing to that wage growth.
And I guess I'd note in your other slides that you had that the health and social services, along with, I think it was education, were the kind of two major growth areas.
Yeah.
Yeah.
So in terms of employment?
Yeah.
Yeah. So while we haven't fully got down to the drivers, I do understand that, well, anecdotally I've heard, there's the idea that the NDIS may be a contributor to that.
Yeah.
So that rollout of the NDIS may be a contributor to in that space.
I think the other big one there is around aged care.
Yes. So.
Okay. Thank you. No further questions.
Thank you.
Can I just pick up on some questions that are asked of you, Mr. Christmas, by Mr. Toomey? I think what Mr. Toomey was advancing through his questions was that growth in GSP is going to rely, at least in part, on increases in household consumption.
Yes,
Okay.
correct.
And I think It was saying obviously wage growth assists with household consumption, make that assumption at least.
Yep.
I think he was further assuming that wage growth can come through increased demand for labour by productivity gains, but also wage growth can come through decisions from bodies like ours. So as an economist, do you have a view on whether there is something wrong with wage growth coming from decisions of bodies such as ours rather than from the market forces? As an economist, do you have a view?
Well, that really depends on a whole range of factors. So it depends on where the market clearing wage might be in a perfectly competitive environment relative to the minimum wage. Where those two are will have an influence. The issue of whether, presumably in a negotiated outcome, there'll be you'd expect that if it's both parties agreeing to that outcome, then the Employment Act, presumably firms are demanding, are happy to pay that rate.
It doesn't seem to be happening at a national level, at least, because we haven't got strong wage growth despite companies doing well. It might be people are scared of robots or whatever the explanation is, but it doesn't seem to be happening at a national level.
Yeah.
So some of the theme of the questioning was, well, who's going to get the ball rolling?
Mm-hmm.
And the theme of some of the questioning was, last year the Fair Work Commission tried to get the ball rolling with a 3.3% increase. The sky hasn't fallen in. Very different here, where we're talking about a decision which impact more on small business at a local level rather than big business at a national level.
Mm-hmm.
But going back to that, as an economist, do you have a view on whether it ought to be us getting the ball rolling or business through market forces ought to get the ball rolling?
So what I was trying to say, is I'm not necessarily taking even able to make that call, because it really depends on where you are. But one of the issues we have talked about is.
I suppose what I'm adding is it's been road tested at national level, and the Fair Work Commission said essentially we're going to get the ball rolling last year, and the national economy has improved since then. If we look at unemployment rates, the state.
Well, yeah, sure. Or even total growth has increased. So there's a general, improvement, you would say, nationally, yeah.
And I suppose what I would say to you, do you have any comment to make about us getting the ball rolling in our environment where this decision will largely affect small business?
Well, my only observation is we're not quite in the same state as the national economy in terms of we're actually coming out of a contraction in GSP, and we're forecasting a decline, albeit tiny, 0.25, so percent decline in domestic demand. So conditions are a little bit different to the national.
Thank you.
No worries.
Mr Entrican, is there anything further with Mr Christmas?
No, Chief Commissioner.
All right. Thank you, Mr Christmas. Once again, we thank you for the advice you've given us and the responses you've provided, and may I say how valuable we find your presentation each year, so thank you.
Thank you.
You made a part.
Thank you.
Now, Mr Entrican,
Thank you, Chief Commissioner.
we take it that you don't intend to read your submission to us, and you can take it that we have actually read it ourselves.
Correct. I'll try to be as fast as I can. And thank you to Mr Christmas for his presentation today. The Minister extends his appreciation for your time. Moving on to the Minister's position, the Minister relies primarily on the written submissions already lodged with the Commission, but I'll take the opportunity just to reiterate the basis of the Minister's position and to address some of the issues that have been raised by the other parties. The Minister recognises the importance of maintaining a strong safety net for those employees who remain in the state jurisdiction. The annual review of the state minimum and award wages plays a critical role in protecting the needs of the low paid and helps to ensure the maintenance of a fair system of wages and conditions of employment. The Minister supports the Commission taking a balanced and equitable approach to minimum and award wage setting to provide for West Australian workers while ensuring any outcome is sustainable. Section 50A of the Industrial Relations Act requires the Commission to consider the need to contribute to improved living standards for those West Australians reliant on minimum and award wages. The Minister believes that granting a real wage increase in this year's state wage order will help to improve the relative economic position of the lowest paid workers, enhancing their standards of living and protecting against the risk of poverty. The Minister submits that this year's state wage order, it is appropriate that the state minimum wage and adult award rates of pay be increased by a flat dollar amount of $19.20 a week. A flat dollar adjustment would ensure the greatest benefit of this year's minimum wage order is directed to the lowest paid. The Minister notes that the Commission has itself targeted those on the minimum wage or slightly above it in previous state wage case decisions. A $19.20 per week adjustment would increase the state minimum wage by approximately 2.7%, taking it to $728.10 for a 38-hour week. But it is worth noting that for other award rates of pay above the minimum, the Minister's position would amount to less than 2.7%. For instance, it would represent approximately a 2.4% increase in the C10 classification in the Metal Trades Award. The Minister acknowledges that a flat dollar increase will create a minor flattening of some award relativities between classifications. However, any change would be minimal. The Minister submits the real wage increase is appropriate, as it's important that low-paid workers do not face a further widening of income inequality, something that can have undesirable social and economic consequences. As outlined in the Minister's written submission, Western Australia's economic and labour market performance has improved noticeably over the past year, and it is appropriate that the living standards of the low paid are maintained and improved in line with those in the broader community. In the year to March 2018, total employment has increased by a healthy 2.2% in annual average terms, following a decline of 1.4% in the 12 months in the year to March 2017. The strong rebound in employment growth was led by a 2.8% increase in full-time hiring, as we saw in Mr Christmas's presentation, which helped to reduce the state's average unemployment rate. Another encouraging sign is the participation rate, which currently stands at 68.8%. For April, that was the equal highest in the last 3 years. A high participation rate is often a sign of growing confidence in the labour market. The Minister notes that the most recent seasonally adjusted figure for average weekly ordinary time earnings in Western Australia is $1,742.80 per week, which actually equates to just under $91,000 per annum. At the same time, the state minimum wage is currently less than $37,000 per annum, and the C10 classification, that is the skilled tradesperson's classification, is a little over $42,000 per annum. As also outlined in the Minister's written submission last year, the most recent employee earnings and hours data from 2016 indicates that award-reliant employees in Western Australia have the third lowest hourly earnings in the country, and this figure is actually lower than the national average. Clearly, minimum and award-reliant employees are not highly paid, and the state wage order can play an integral role in not only maintaining a safety net for such workers, but ensuring their livelihood. Many low-paid workers are unable to bargain for higher wages and are solely dependent on increases determined in the state wage case to meet changes in their everyday living costs. The Minister also notes that there are sections of the workforce that are currently award-free in the state jurisdiction, including workers engaged in a number of occupations that would traditionally be considered award-type work. As outlined in the Minister's submission, this is due to a variety of factors, such as historic anomalies in award creation, significant changes in the constitutional coverage of the state jurisdiction, and the development of new industries and occupations over time. As award-free employees have far fewer protections and are solely reliant on the minimum rates of pay determined under the Minimum Conditions of Employment Act, the Minister submits it's important that such employees are appropriately protected through a fair and meaningful increase in the state wage case. I'll now address briefly a few of the other issues that have been raised by other parties in their submissions. In relation to the CCI, in its submission, the CCI advocates for the minimum wage and state award wages to be increased by not more than 1.2%. While the Minister appreciates the CCI is advocating for an increase to minimum and award wages in this year's state wage case, the Minister respectfully submits that the quantum proposed by the CCI would not provide low-paid employees with a meaningful wage increase in the current environment. Although wages growth is currently modest, rates of pay are nonetheless rising, and as we saw in the presentation, the wage price index is projected to increase by 1.5% in 2017-18 and 1.75% in 18-19, rising further in the out years. Furthermore, average weekly ordinary time earnings increased by 2.3% in the year to November 2017, which is another sign that wages growth is gradually strengthening in Western Australia, in line with the recovery in the domestic economy. An increase of 1.2% or less would effectively see wages of minimum and award wage earners rise by less than the workforce as a whole, contributing to an increase in wage inequality and a deterioration in the minimum wage bite. By granting regular real wage increases over the last few years, the Commission has played a crucial role in countering wage inequality, an issue that is crucial to the continued prosperity of the state and its social cohesion. The Minister notes the significant improvements in business confidence within Western Australia in more recent months, as evidenced by the CCI's own survey of business confidence, which showed that business confidence in Western Australia is at the highest level in 7 years. The Minister submits that an increase of $19.20 per week would provide a fair and sustainable increase for minimum and award wage earners. The Minister notes the CCI has raised the issue of the state minimum wage and state award wages being higher than in the national jurisdiction, arguing that, on the one hand, this places WA employers at a cost disadvantage compared to their national counterparts. However, in that regard, the Minister notes that not all minimum wage rates in the state industrial relations system are higher than in the national jurisdiction. As illustrated in the Minister's written submission in reply, the statutory minimum rate for an adult casual employee in the state system is currently lower than it is in the national jurisdiction, due to a higher casual loading being applied in the national system. And the statutory minimum rates for many award-free trainees, apprentices and some award-free junior employees in the state system are also currently lower than in the national system. So while some rates of pay in state awards are marginally higher than in comparable national awards, it should also be noted that other rates of pay are lower. For example, the minimum rate of pay for a part-time adult shop assistant working on a Saturday morning is currently $23.54 an hour in the state system, whereas it's $25.10 per hour in the national system. Similarly, the rate of pay for a casual hotel bartender, a level 2, working on a Sunday is $29.73 per hour in the state system, whereas it's $34.18 in the national system. As mentioned earlier, it's also relevant to note that there are sections of the workforce that are currently award-free in the state jurisdiction, including workers engaged in occupations that are covered by awards in the national jurisdiction. In the national system, almost all employees below the professional or managerial level are covered by an award. Employees who are not covered by any other award generally fall within the coverage of the Miscellaneous Award 2010, and that award includes penalty rates, overtime provisions and annual leave loading, which are all entitlements that are not provided for under the state minimum conditions of employment. In relation to Unions WA's submission, the Minister notes that Unions WA recommends the Commission increase the minimum and award wages by $50 a week, or 6.2%, whichever is the higher. In practice, this would mean the state minimum wage and award wages up to and including the C10 classification would increase by $50 per week, and award wages above C10 would increase by 6.2%. The Minister recognises the importance of maintaining a strong and meaningful safety net for those employees who remain in the state jurisdiction, and shares the concern of Unions WA that the living standards of the low paid be protected. In that regard, the annual state wage case process plays a vital role in ensuring the maintenance of a fair system of wages and conditions of employment. While the Minister supports a real wage increase that will positively benefit low paid workers, it is also important that any outcome fosters an environment that will support increased jobs growth and enhance labour market opportunities. The Minister encourages the Commission to award a fair and sustainable outcome in this year's wage case, and contends that an increase of $19.20 a week would appropriately achieve this aim. In relation to WACOS, as with Unions WA, WACOS proposes a $50 per week increase in minimum and award wages, albeit it has not specifically proposed a 6.2% increase for rates of pay above the C10 classification. As the quantum proposed by WACOS is similar to that of Unions WA, the Minister's earlier comments in regards to Unions WA would be relevant in the case of WACOS as well. The Minister notes that WACOS proposes its recommended $50 a week increase in award rates be flowed on in full to junior employees, apprentices and trainees. In its written submission, WACOS has acknowledged that statutory rates of pay for junior employees are automatically determined as a relevant percentage of the adult minimum wage under Section 13 of the Minimum Conditions of Employment Act. However, it continues to advocate the merits of a $50 a week increase for all employee groups. Putting aside the statutory considerations concerning minimum wage rates for junior employees, raising all junior apprentice and trainee rates of pay by $50 per week would represent a significant increase in pay for many of these workers, in some cases up to and exceeding 20%. Such a large increase could potentially have unintended consequences, and the Minister would not wish to jeopardise the employment and training prospects of some of the more vulnerable employees in the workforce. Many state awards also contain specific formulas for determining junior apprentice and trainee rates of pay, often based on a percentage of the adult wage classification. The Commission would therefore be required to vary or override existing wage formulas in a substantial number of awards if it was to apply a flat $50 a week increase to all wages. The Minister contends that any increase to adult rates of pay determined in this year's state wage case should be flowed on to juniors, apprentices and trainees in accordance with existing mechanisms. Should there be a need to review the rates of pay for employees in a particular industry or occupation, this can be dealt with on an award-by-award basis through application to the Commission. In relation to the Australian Hotels Association, the Minister notes that the Hotels Association has advocated the state minimum wage and award wages be increased by 1%. As with the CCI, the Minister respectfully submits that the quantum proposed by the Hotels Association would not provide low-paid employees with a meaningful wage adjustment in the current environment. The Minister submits that an increase of 1% would not provide a sufficient increase in wages to safeguard the needs of minimum and award wage workers, particularly as their wages would not keep pace with those in the broader community. The Hotels Association has submitted that in accordance with Section 50A(3)(f) of the Industrial Relations Act, the Commission should consider the ongoing effects of the penalty rates decision made by the Fair Work Commission. In particular, it states that the vast majority of employers in the hospitality industry in Western Australia are not covered by the state system and continue to enjoy not only lower minimum hourly rates for most classifications, but the ongoing benefit of reduced penalties on public holidays. The Minister contends that the level penalty rates determined in national awards should have no bearing on the state wage case, particularly given the different statutory provisions underpinning the state and national labour relations frameworks. Many employees in the retail and hospitality industries rely on penalty rates to make ends meet, and the West Australian Government believes employees who work unsociable or non-standard hours should be fairly compensated for their efforts. The Hotels Association also provides examples of award rates of pay in the hospitality industry that are higher in the state system than in the national system. In particular, rates of pay for a bartender, level 2, working on a Saturday and a public holiday, are compared between jurisdictions using the rates of pay in the National Hospitality Industry Award and the State Hotel and Tavern Workers Award. In that regard, the Minister contends that not all of the wage rates in the state hospitality industry are higher than in the national system. In fact, a comparison of the rates of pay in the National Award and the State Award reveals that minimum rates of pay for working on a Sunday are currently lower in the state system than under the national system, and that's for full-time, part-time and casual employees. Minimum rates of pay for casual employees working on a public holiday are in fact lower under the State Award than under the National Award. And minimum rates of pay for work performed on weekday evenings after 7 p.m. are also marginally lower under the State Award than under the National Award, and that's for full-time, part-time and casual employees. In addition to the above, casual employees are not entitled to overtime rates under the State Award, whereas they are entitled to overtime under the National Award. So the Minister would caution against making broad assumptions that state system employers in the hospitality industry or other industries are always at a comparative disadvantage with their counterparts in the national system when it comes to wage costs.
Another option, of course, and I say this firmly with my tongue in cheek, is that the national system might follow the state system.
It could indeed.
It might resolve some of those difficulties.
Quite correct. Chief Commissioner, not expecting it, but...
I don't expect you to comment on it, but nonetheless.
But you're correct, one could switch it around. In relation to the state wage fixing principles, as part of this year's state wage case, the Commission's indicated it would result from receiving submissions about the currency of the statement of principles, and in particular whether a separate equal remuneration principle should be developed. Section 50A(1)(d) of the Industrial Relations Act requires the Commission, when issuing a state wage order each year, to set out a statement of principles to be applied and followed in relation to the exercise of its jurisdiction under the Act to set wages, salaries, allowances or other remuneration of employees or prices to be paid in respect of their employment. Section 50A(3)(a) VII of the Act provides that when making a state wage order, the Commission is to take into consideration the need to provide equal remuneration for men and women for work of equal or comparable value. As part of the 2007 state wage case, the submissions of Unions WA and the Minister sought to have a separate equal remuneration provision included in the Statement of Principles to establish a process and criteria for determining how the Commission could assess applications for award variations to provide equal remuneration. In its reasons for the decision, the Commission expressed the view that the principle should permit an application to be made for equal remuneration, given that this is a principal object of the Act. However, the Commission did not consider it necessary to create a separate principle for equal remuneration, stating that such a claim could be brought under the existing Principle 10. Nor did the Commission consider it advisable to set out the criteria by which such a claim could be addressed, expressing a view that specific criteria might restrict or confine a particular claim, which may or may not be appropriate. The following year, in the 2008 state wage case, the Minister's submission proposed that Principle 10 be modified to include specific reference to equal remuneration, to give parties guidance on that matter. And the Commission agreed with the Minister's proposal, and Principle 10 was modified to include specific reference to the fact it could be used for matters such as equal remuneration for men and women for work of equal or comparable value. Principle 10 has not yet been used to bring a specific equal pay application in the state jurisdiction, and no legislative or case law criteria currently exist to guide the Commission in determining an equal remuneration matter. As the Commission and Section 50 parties are no doubt aware, the Ministerial Review of the State Industrial Relations System is currently considering the inclusion of an equal remuneration provision in the Industrial Relations Act, with the objective of facilitating the conduct of equal remuneration cases and other initiatives in the Commission. The interim report of the review was published on the 20th of March 2018. The Minister places on record the West Australian Government's strong support for the principle of equal remuneration and commends initiatives aimed at furthering this objective. The Minister notes that it is open to the Commission to amend the principles to advance equal remuneration matters, including through the establishment of a separate equal remuneration principle. The Minister would welcome the opportunity to work with the other Section 50 parties to develop a draft equal remuneration principle for the Commission's consideration that reflects best practice in gender equity evaluation. The Minister notes the Commission has also invited feedback on whether, in light of the ministerial review, the principles ought to be amended at this time or await the outcome of the review. In this particular issue, the Minister does not believe there's any particular reason to delay the introduction of an equal remuneration principle. Indeed, the Minister submits that the rationale for including an equal remuneration principle remains as relevant today as it did in 2007. The Minister contends that the Statement of Principles as a living document should reflect contemporary circumstances in state wage orders from year to year and can be updated or amended as and when needed. The introduction of an equal remuneration principle would provide guidance to employers, unions and the Commission on the process and criteria expected of parties in equal remuneration matters brought before the Commission. Turning to other issues.
Before you do, Mr. Intrican, and I would welcome the other Section 50 parties' comments on this also, and that is that 2007 was a long time ago. Things have changed in that time. There is within Principle 10 a recognition of the capacity to bring an equal remuneration case, but as you say, there are no guidelines as to what that might be. The Commission can issue a state wage order only once a year, so one would assume that we're not going to be able to prepare a principle in this state wage order because we have no submissions on what that might contain. What occurred to me was that, and I'm conscious of the review of the state industrial relations system, and that I think relatively shortly there will be a final report. But these things take their time, and government consideration as to whether or not it will be acted upon, and if so, to what extent and when. So if we were to move on that matter, I would welcome any comment regarding whether the Commission ought, of its own motion, bring on an application for a general order, and in that way provide a process for interested parties to participate in conciliation with a view to developing by consent a set of principles dealing with equal remuneration, and if not, whether that's a matter that ultimately might go to arbitration for the creation of a principle separate from the statement of principles at this stage, but possibly with a view to it being collapsed into the statement of principles on another occasion. So that's something I would welcome comment from yourself and from the others when they're turn comes. So any thoughts on that, Mr Intrican?
And in that regard, I'm happy to look into that proposal. So the Minister is more than willing to participate in whatever forum is deemed most appropriate for facilitating an equal remuneration principle. So that may well be another mechanism for dealing with it, certainly. Just in relation to the other principles, the Minister notes most of them were last reviewed in the 2008 state wage case, and they've not substantively been revised since that time. The Minister contends the majority of the principles are adequate for the purposes of the state wage order, albeit some of them have been in existence for quite a long time, and reflect particular developments in national and state wage case proceedings over the years. However, the Minister believes that several of the principles could benefit from amendment to provide clearer information to employers and employees and to better reflect the contemporary safety net that currently exists in the state jurisdiction. In this regard, the Minister makes the following observations. For Principles 8.1 and 8.2, the principles currently provide that where the minimum rates adjustment process in an award has been completed, the Commission may consider an application for the base rate, supplementary payment and the state wage order adjustments to be combined, so the award specifies only the total minimum rate for each classification. And 8.2 then provides that by consent of all parties to an award, where the minimum rates adjustment has been completed, award rates may be expressed as hourly rates or weekly rates. In the absence of consent, a claim that award rates may be so expressed may be determined by arbitration. Minimum rates adjustment process dates back to the 1980s and was part of the structural efficiency principle introduced to make awards more flexible and efficient. And while award parties still have the option of progressing a minimum rates adjustment process, the Minister is not seeking to remove this option. However, the Minister contends there may be merit in deleting Principles 8.1 and 8.2.
You could also delete 8.3, I suspect, because all that does is reflect the current state wage, or the then current state wage order.
Indeed, yes.
And
yes.
You could delete it because, as you say, there is reference in Principle 4 to previous state wage orders, so
correct.
That could
yes.
be dealt with. One thing that arises from that, from my perspective, is that 8.1 and 8.2, well, particularly 8.1, talks about the fact that a number of the awards have minimum rates adjustments and supplementary payments. They have various components that make up the total rate. I suspect that there is very, very little relevance now to having those separately identified, and that there is very little within the remainder of the award that relies upon those separate components. And whether it would be easier, whether it makes any difference to any other benefit within the award, to simply have them all dealt with by way of, and I don't want to create work for the Commission's award section, but if we were to undertake that process of collapsing those rates into a total rate in those awards where there is that, to simplify the awards, and the focus that the Minister has made on these principles, I think, is to make the awards more comprehensible by people, particularly seeing as many of them are not utilised a great deal.
Correct, yes. Yes, certainly I guess there's a two-step process there with
Yes.
Deleting Principles 8.1 and 8.2 on its own obviously won't make any change to the awards in question. And it simply 8.1 and 8.2, well, 8.1 was included first in the national wage case in 94 and then 8.2 in 97, and that quickly flowed on to the state principles. But at the time, in 1989, when the minimum rates adjustment was introduced in the national system, that was the only way that you could actually get a wage increase, was to go through this structural efficiency process. And there were a number of other things besides just minimum rates adjustments. But it was kind of an expectation that everybody would go through this.
And they haven't.
And they haven't.
No.
And you had to go through that process to get an increase. And so 8.1 and 8.2 are just kind of the, the tail end of that process. But it was written in the mid-90s for that particular point in time, when it was anticipated that all of these awards would then be coming through in the near future, having completed the minimum rates adjustment process. And obviously, for various reasons, that hasn't happened. So deleting those on its own won't obviously change the way that those things are expressed in awards. But then, yes, there's certainly the further options in terms of whether or not wages in general are expressed in a simplified manner.
That scheme was very much a product of a bygone era, if I can use that phrase advisedly. Time has moved on, I suspect.
Indeed, yes. The fact that the base rates, supplementary payments, which were above award payments, rolled into the awards where they were made minimum rates, and then arbitrated safety net adjustments. In some state awards, the arbitrated safety net adjustment figure actually exceeds the base rate figure, so they've had many, many years of arbitrated safety net adjustments added on. So, certainly the Minister's happy to look at it.
Well, it might be then that in the same way as I'm suggesting, the Commission, of its own motion, take up a principle related to equal remuneration. It might be that, as the Chief Commissioner did in 2008 in respect of a couple of the other issues that you've raised, that the Commission might act on those things of its own volition to examine those.
Certainly. So as mentioned, the removal of principles 8.1 and 2 certainly wouldn't remove the option of conducting a minimum rates adjustment. The Minister's not seeking to remove that option. It would simply allow parties the option of applying to have wage rates expressed in a simplified manner if they so choose. Moving on to just Principle 9, the minimum adult award wage clause is currently included in state awards. When examining the clause, the Minister's identified several issues concerning the existing wording. One of those issues is the 40-hour week that's still contained in some awards. With regard to rates of pay, the minimum adult award wage clause doesn't specifically account for those state awards that have the 40-hour week. The current wording of the clause is that the minimum adult award wage for full-time employees aged 21 or more is $708.90 per week, payable on and from the commencement of the first pay period on or after 1 July 2017. An issue that arises is the rate of $708.90 per week is based on a 38-hour week, not a 40-hour week. So pursuant to Section 10 of the Minimum Conditions of Employment Act, an employee is entitled to be paid for each hour worked the applicable minimum weekly rate of pay divided by 38. As the minimum hourly rate of pay for an employee who's reached 21 years of age and is not an apprentice is currently $18.66 an hour, an employee working a 40-hour week is entitled to receive a minimum payment of $746.40 at present. That is 40 times $18.66.
So that would be an extra 2 hours a week on top of the
Correct.
the minimum weekly rate.
Correct, yes. And a similar issue arises in relation to the minimum adult apprentice wage. The minimum adult award wage clause currently provides that, notwithstanding the provisions of this clause, an apprentice 21 years of age or more should not be paid less than $607.60 per week on and from the commencement of the first pay period on or after 1 July 2017. The minimum hourly rate of pay for an adult apprentice who has reached 21 years of age is currently $15.99 per hour, which is calculated by dividing the $607.60 by 38. So an adult apprentice working a 40-hour week is therefore entitled to receive a minimum payment of $639.60 at present. That is 40 times $15.99. So to provide greater clarity to employers and employees, the Minister recommends that the minimum adult award wage clause be amended to specifically include information on what the minimum rate of pay is for an adult employee and an adult apprentice working under an award that provides for a 40-hour week. This will help to signal to employers what the statutory minimum wage obligations are under those awards and assist with preventing underpayments. A similar issue arises with junior rates of pay. With the minimum adult award wage clause, it currently states that employees under the age of 21 shall be paid no less than the wage determined by applying the percentage prescribed in the junior rates provision in this award to the minimum adult award wage clause. A difficulty with this provision is that in some awards the percentages prescribed for junior rates are set at a level which, when they're applied to the minimum adult award, solution for that is that the minimum adult award wage clause could specifically just include a provision that clarifies junior employees should not be paid less than any applicable minimum rate of pay prescribed by the Minimum Conditions of Employment Act. A similar statement to this effect is currently included under provisions of the clause addressing wage rates for apprentices, trainees and apprentices, trainees and supported wages employees. And the inclusion of such a statement for junior employees may assist employers in understanding their obligations in regard to payment to junior employees.
Mr. Entrekin, do you happen to have a list of the awards that you say suffer from the difficulties that you've raised in respect of the minimum adult award wage for the 40-hour week issue and for the junior rates?
Chief Commissioner, we have a preliminary list. We haven't had a chance to actually check it off, if you like, or verify it. But a preliminary list which indicates there's about 28 awards that have rates of pay that are below the statutory minimum wage. I would note that the majority of those awards, it's actually junior rates that are the problem. However, there are a few that where adult rates are.
And is it only for that reason? It's limited to the issue arising because of the effect of a 40-hour week?
Mostly.
But not exclusively?
Not exclusively. I have picked up a rate of pay that's below $708.90 for the, I think it's the Commercial Travellers and Sales Representatives Award. It's for the first 9 months of the job, so that may have slipped through the general order in 2008. Generally speaking, most 38-hour week awards do have minimum rates that are at least $708.90 for adults because of that general order in 2008, which corrected a lot of those rates were below the minimums. So in most cases, it's the 40-hour week issue and the percentages for juniors in certain awards that are the main problem with those. Yeah.
Mr. Entrekin, I'm not sure, but I suspect that these are not issues of principle, but issues of mechanics. Is that possible?
A little bit of both. A little bit of both, yes.
Right.
Yes.
I'm wondering whether you've had an opportunity to discuss the matter with the other Section 50 parties to see if you can come to a resolution about both the principal and the mechanics.
Sure. Yes.
Because what I was going to ask you, if you would possibly be able to prepare a form of words that might assist and how that might be achieved within the state wage process, or once again whether we need to do a separate process. So, as was done in 2008
Yes.
in respect of those other matters. So,
Certainly.
I wonder if you might have that opportunity over the next few days to see if, having thought that when you leave here that you've finished your work on this, perhaps not.
Yeah, no, I'm more than happy to have discussions with the other parties. I anticipated that might be the case, so I'll certainly endeavour to do so.
I think that would be very helpful to us.
Certainly, yes. So I guess in regard to the minimum adult award wage clause, there's just an issue that for certain awards it just provides an incorrect statement, if you like. And then there's the broader issue of the actual adjustment of those wages in practice.
Yes.
In the actual awards.
Well, one of the things that occurs to me is that the order that we issue each year results in an amendment to each of the awards, which contains a clause dealing with the minimum wage, and there is conflict between those awards which have rates of pay which might be lower than the minimum wage, and unless an employer is alert to that, they may end up paying the lower award rate than the minimum rate. And whether we ought to do something more specific about actually updating those award rates rather than merely contain a statement within the award. So there are a range of issues.
And the Minister was certainly going to suggest that in addition to the statement of principles, that it may actually be convenient or to actually deal with that as part of the state wage order, that those
Yes.
rates could actually be adjusted to bring them up to the Minimum Conditions of Employment Act rate.
So you might end up having collapsing all of the different rates into a total rate and removing for the minimum rates adjustment, and then dealing with the 40-hour week issue and dealing with the minimum wage issue all through a process agreed between the parties.
That could certainly be
Yes.
an option, yes, is to potentially it could all be done through a general order.
And do you think potentially through this general order this year?
Well, certainly the adjustment of rates to bring them up to the minimum conditions of employment, the Minister certainly believes that it's within the power of the Commission to do so. So when the order is issued each year, there's already a list of awards that the order doesn't apply to. Old long service leave awards and superannuation awards or conditions awards. And then there's another list of awards where the state wage order only applies to some wages clauses within them, but not all of the wages clauses, because they've imported industrial agreements into the award as a schedule. So there's already lists of awards that are exceptions, if you like, and it may be possible just to actually list, to have another standalone list where the actual rates are just listed in the order, so that while there's a general increase of X amount, in addition the other rates are brought up to the minimum as part of the state wage order. The Minister will be happy to identify those wage rates. At the moment, the Department produces 35 award summaries for the most utilised awards in calls to wage line. So for those 35 award summaries, we actually do list the minimum conditions of employment, which overrides the award, and so we do actually have a notation under the wages clause that basically says please note some of these rates are above what's listed in the award. Unfortunately, that's only 35 of the awards, so there are
Yes.
some awards where we don't have a summary, and if you just looked at the award, it wouldn't tell you.
No, and the award rather than your helpful summary needs attention, it would appear.
And there's no doubt there's power, as you note in your submission, section 50A2 of the Act clearly enables
Yes.
individual adjustments to be made that might be considered necessary.
Yes, indeed. Yeah.
All right, well, perhaps we can leave that with you, Mr Intrican, if you could
Sure,
corral the others and see what you can do with that.
certainly.
All right.
No problem.
Now, we might take the luncheon adjournment now, unless you're only going to be a minute or two, but I suspect you'll be a little longer.
Very close to the end. Probably a minute or two.
All right,
Yep.
thank you.
Just moving on briefly to apprenticeships and traineeships. The Minister's written submission includes detail on apprenticeship and traineeship commencements and numbers in training. It also includes analysis of some of the factors that are influencing the uptake of training opportunities in Western Australia. The information and analysis has been provided by the Department of Training and Workforce Development, and the Minister thanks the staff who have provided that information. As outlined in the Minister's submission, apprenticeship and traineeship commencements have declined in recent years, although the Minister is pleased to note that in the past 12 months, apprenticeship commencements have stabilised. Training commencements are influenced by a diverse range of factors, a number of which are discussed in the Minister's written submission. In conclusion, the annual state wage order plays a vital role in maintaining a strong and sustainable safety net for employees in the state industrial relations jurisdiction by protecting the needs of the low paid and maintaining a fair system of wages for West Australian workers. As discussed in this submission, the Minister supports the Commission taking a balanced and equitable approach to minimum and award wage setting. This includes consideration of all the social, economic and labour market objectives prescribed in section 50A3 of the Industrial Relations Act, including the requirement to consider the need to contribute to improved living standards of those West Australians reliant on the state minimum wage and state award rates of pay. As outlined, the Minister believes that granting a real wage increase in 2018 to the low paid via a $19.20 per week adjustment to minimum and award wages represents a fair and meaningful quantum that would provide an increase to minimum and award wage earners, improving their relative economic position in the community and enhancing their standards of living. The Minister submits that the effective date of the state wage order and any adjustment to minimum wages should be 1 July 2018, applicable in the first pay period on or after that date. The Minister has no further substantive information for these proceedings, though the Minister reserves the right to respond to matters raised in the presentations of the other parties. If it pleases the Commission and Court session, that concludes the Minister's primary submission.
Thank you.
I'll ask my question of you, Mr Intrican, and you can think about it and answer me after lunch then, perhaps. We know down this end of the table there's a desire for the minimum wage increase to be a signal, so it'll flow up, and we have a concern from CCI that it's a signal. So let's say, assume that they're real things, that 2.7% flows through.
Yeah.
Let's also assume, I don't think we have to assume it, that if wages policy is stuck to, I think, for everyone above $36,000, you don't get a 2.7% wage increase. And my question for you, having gone into some detail to economic matters in your submissions, is why does the Minister say that small business is better able to pay a 2.7% increase than government?
Sure. I'll answer you after lunch, yeah. Thank you. Sure.
All right, thank you. We'll adjourn until 2:15. Thank you.